Finance is basically just humans trying to figure out what to do with money across time, and we're really, really bad at it. But hey, at least we've created an entire global system around being confused about numbers together. Let's start with the basics. Money itself is just a medium of exchange, which is a fancy way of saying stuff we all agree is worth stuff. Back in the day, people used to trade chickens for wheat, but carrying around livestock gets messy. So we invented coins, then paper, and now we just move invisible numbers around and pretend it's the same thing. The value of money comes from trust, which is terrifying if you think about it too long. The US dollar is valuable because everyone believes it's valuable, which means the entire global economy is essentially running on a shared delusion. Fun fact, this is called fiat currency. It has value because the government says so, not because it's backed by gold or anything tangible. Now, here's where things get interesting. You can't just stuff money under your mattress forever because of this annoying thing called inflation. Inflation is when prices go up over time, which means your money loses purchasing power. That $100 bill from 1990, it's worth about $50 in today's money. Thanks, inflation. You're basically getting poorer by doing nothing, which is why finance exists in the first place. This brings us to the fundamental concept that makes finance tick: the time value of money. $1 today is worth more than $1 tomorrow, not because of some philosophical reason, but because you can do stuff with that dollar today. You could invest it, spend it, or at the very least, avoid the inflation monster eating away at it. Speaking of investing, let's talk about how people try to make their money work for them instead of the other way around. The most basic form is putting money in a bank account where it earns interest. Interest is basically the bank paying you to let them use your money to do bank things, like lending it to other people at higher rates. It's like lending your car to a friend who uses it to run an Uber business and gives you a cut of the profits. But bank interest rates are usually pretty pathetic, especially compared to inflation, so people look for better options. Enter the stock market, which is essentially a giant auction house where people buy and sell pieces of companies. When you buy a stock, you're buying a tiny slice of a company, hoping that company will become more valuable over time. Here's the thing about stocks. They go up and down like a caffeinated yo-yo, and nobody really knows why on any given day. Sure, there are fundamental reasons: company earnings, economic conditions, industry trends. But day-to-day stock movements are basically just the collective mood swings of millions of investors. One day everyone loves Tesla, the next day they're convinced it's overpriced. It's like high school, but with money. The beautiful and terrifying thing about the stock market is that it's essentially a prediction machine for the future. Stock prices represent what investors think a company will be worth, not what it's worth right now. This is why companies with no profits can have billion-dollar valuations, and why established companies can crash overnight. We're all just guessing about the future, and some guesses are more expensive than others. But wait, there's more. If stocks are too spicy for you, there are bonds, which are basically IOUs. When you buy a bond, you're lending money to a government or company, and they promise to pay you back with interest. It's like being the bank, except you're probably not going to foreclose on anyone's house. Bonds are generally safer than stocks, but they also offer lower returns, because apparently you can't have nice things. The relationship between risk and return is one of the fundamental laws of finance. Want higher returns? You have to accept higher risk. Want safety? You get lower returns. It's like the universe's way of making sure nobody gets to have their cake and eat it too. This is why your grandmother's savings account earns basically nothing, while that guy who bought Bitcoin at the right time is either rich or broke, depending on when you ask. Now let's talk about compound interest, which Einstein allegedly called the eighth wonder of the world, though he probably never said that because people love attributing quotes to Einstein. Compound interest is when you earn interest on your interest, creating a snowball effect. Start with $1,000, earn 10% interest, and you have $1,100. Next year, you earn 10% on $1,100, giving you $1,200 and $10. It doesn't sound like much, but over decades, this compounding effect becomes absolutely bonkers. Here's a mind-bending example. If you invested $1,000 at age 20 and earned an average return of 7% annually, by age 65, you'd have about $30,000. But if you waited until age 30 to start, you'd only have about $15,000. Those 10 years cost you half your retirement money. Time is literally money, and compound interest is the interest rate. But compound interest works both ways, which brings us to debt, the evil twin of investing. When you borrow money, you're on the wrong side of compound interest. Credit card debt, for example, typically charges around 20% annual interest, which means your debt can double in less than 4 years if you only make minimum payments. It's like compound interest, but instead of making you rich, it makes credit card companies rich. This is why personal finance gurus are always screaming about paying off high-interest debt first. It's not because they hate fun, it's because the math is brutal. If you're earning 7% on your investments while paying 20% on credit card debt, you're essentially paying 13% for the privilege of feeling like an investor. That's not investing. That's expensive performance art. Speaking of debt, let's talk about mortgages, which are basically 30-year commitments to pay for a house that you get to live in while you're paying for it. A mortgage is secured debt, meaning the house itself is collateral. If you stop paying, the bank takes the house, which is called foreclosure, and it's about as fun as it sounds. The mortgage industry exists because houses are expensive and most people don't have $300,000 lying around. So banks lend you the money, you pay it back over 3 decades with interest, and everyone pretends this is a normal way to live. The weird part is that this system has convinced people that paying rent is throwing money away, while paying mortgage interest somehow isn't. But mortgages bring us to a crucial concept: leverage. Leverage is using borrowed money to buy something, hoping it will increase in value more than the cost of borrowing. With a house, you might put down $50,000 and borrow $250,000. If the house value goes up 10% to $330,000, you've made $30,000 on your $50,000 investment. That's a 60% return. Of course, if the house value drops 10%, you've lost $30,000, which is also a 60% loss. Leverage amplifies everything, both gains and losses. This brings us to the 2008 financial crisis, which happened because everyone forgot that house prices can go down. Banks were giving mortgages to people who couldn't afford them, then packaging those mortgages into complex securities and selling them to investors. When house prices dropped, the whole system collapsed like a house of cards made of, well, houses. The lesson? Financial innovation often just means finding new ways to hide risk. And when everyone thinks they've found a way to make money without risk, that's usually when things go spectacularly wrong. Let's zoom out and talk about the broader financial system. At the center of it all is the Federal Reserve, which is basically the bank for banks. The Fed controls interest rates, which affects everything from mortgage rates to stock prices, to whether your savings account earns anything. When the economy is growing too fast and inflation is rising, the Fed raises interest rates to cool things down. When the economy is struggling, they lower rates to encourage borrowing and spending. This is monetary policy, and it's like steering a cruise ship with a toothpick. It takes forever to work, and by the time you see the effects, the problem might have changed. The Fed is constantly trying to thread the needle between inflation and recession, and their track record is mixed. Then there's fiscal policy, which is what the government does with taxes and spending. Want to stimulate the economy? Cut taxes or increase spending. Want to cool down inflation? Raise taxes or cut spending. Of course, politicians love cutting taxes and increasing spending because that makes people happy, which is why government debt keeps growing and nobody wants to talk about it. International finance adds another layer of complexity. Different countries have different currencies, and those currencies trade against each other in foreign exchange markets. The exchange rate between dollars and euros affects everything from the price of your vacation to the competitiveness of American exports. Currency trading is like the stock market, but instead of buying pieces of companies, you're betting on entire countries. Now, let's talk about some of the more exotic financial instruments that have been invented over the years. Derivatives are financial contracts whose value is derived from something else, like a stock, commodity, or interest rate. Options give you the right to buy or sell something at a specific price. Futures let you agree to buy or sell something at a future date. These can be useful for hedging risk, but they can also be used for speculation, which is basically sophisticated gambling. Remember those mortgage-backed securities from 2008? Those were derivatives. Credit default swaps, which are basically insurance on debt, are derivatives. The derivatives market is worth hundreds of trillions of dollars, which is more than the entire global economy, because the same underlying assets can support multiple derivative contracts. It's like a pyramid scheme, but legal and somehow essential to modern finance. Insurance is another huge part of the financial system. You pay premiums to transfer risk to insurance companies who pool everyone's premiums and pay out claims. It works because not everyone needs to claim at the same time, and insurance companies are really good at calculating probabilities. Health insurance, car insurance, life insurance, it's all about spreading risk across many people. The life insurance industry has created some particularly creative products. Whole life insurance combines insurance with investment, which sounds great until you realize you're probably better off buying term life insurance and investing the difference yourself. But insurance salespeople don't get big commissions on simple products, so they've invented complex products with names like Universal Variable Life that even financial professionals struggle to understand. Speaking of financial professionals, let's talk about the army of people who make money by handling other people's money. Financial advisors, investment bankers, hedge fund managers, private equity firms, they all take a cut of your money in exchange for promising to make you more money. Sometimes they do, sometimes they don't, but they almost always get paid regardless. The hedge fund industry is particularly fascinating. These are investment funds that use sophisticated strategies and charge high fees, typically 2% of assets under management plus 20% of profits. The idea is that they're so smart they can make money in any market condition. In reality, most hedge funds underperform the stock market after fees, but they're still managing trillions of dollars because apparently hope springs eternal. Private equity is another corner of finance where firms buy companies, usually with lots of borrowed money, try to improve them, and then sell them for a profit. Sometimes this works great and creates value. Sometimes it results in companies being loaded with debt and stripped for parts. It depends on whether you're the private equity firm or the company being bought. Investment banking is where young, ambitious people go to work 100-hour weeks, moving money around for rich people and corporations. Investment banks help companies go public, issue bonds, and make acquisitions. They also trade securities for their own accounts, which sometimes creates conflicts of interest that are totally shocking to nobody who's been paying attention. The rise of technology has democratized finance in some ways and complicated it in others. Robo-advisors use algorithms to manage portfolios for a fraction of what human advisors charge. Apps let you invest spare change or trade stocks commission-free. Cryptocurrency promises to revolutionize money itself, though mostly it's been a speculative playground for people who think traditional finance isn't volatile enough. Bitcoin and other cryptocurrencies represent an attempt to create money without governments or banks. The technology is genuinely innovative, but the investment mania around crypto has been intense. Bitcoin has gone from worthless to nearly $70,000 and back down again multiple times, proving that humans will find new ways to experience financial bubbles regardless of the underlying technology. But here's the thing about all this complexity. Most people don't need to understand derivatives or cryptocurrency to build wealth. The basics still work. Spend less than you earn, invest the difference in low-cost index funds, avoid high-interest debt, and let compound interest work its magic over decades. It's boring, but boring often wins in finance. The financial industry has a vested interest in making things seem complicated because complexity justifies fees. But the core principles of personal finance haven't changed. Save money, invest it sensibly, diversify your holdings, and don't panic when markets go crazy. Everything else is mostly noise designed to separate you from your money. That said, understanding finance is increasingly important because financial decisions affect everything from your retirement to your ability to buy a house to whether you can afford to get sick. Financial literacy isn't just about getting rich, it's about not getting financially destroyed by life's inevitable surprises. The global financial system, for all its flaws and complexity, serves some important functions. It allocates capital to where it's most needed, allows people to save for the future and borrow for the present, and provides ways to manage risk. Without it, we'd still be trading chickens for wheat, and good luck saving for retirement with livestock. But the system also creates inequality, instability, and opportunities for exploitation. The same mechanisms that allow productive investment also enable speculation and market manipulation. The same innovations that spread risk can also spread contagion when things go wrong. Maybe the most important thing to understand about finance is that it's not a force of nature. It's a human creation that reflects human psychology, complete with all our biases, fears, and irrational impulses. Markets aren't perfectly efficient. They're driven by people making decisions based on incomplete information and influenced by emotions. This is both terrifying and liberating. Terrifying because it means the financial system is ultimately built on the collective sanity of humans, which, well, look around. But liberating because it means you don't have to be a genius to succeed financially. You just have to be slightly more rational than average and stick to the basics over long periods of time. So there you have it, finance in all its confusing, contradictory, occasionally terrifying glory. It's a system where numbers matter, but psychology often matters more, where the smartest people in the room are sometimes the wrongest, and where the most boring strategies often produce the best results. And somehow, despite all the chaos and complexity, it mostly works well enough to keep civilization running.